Brace yourselves for the scariest time. The horrors of the financial crisis of 2008 are probably going to return. The Fed's actions have attracted the attention of many financial analysts and professionals, and every sign points to a challenging future. There is a high chance that the biggest recession ever is coming. The economy is about to crash and many jobs will be destroyed. We're aware of the strangling effects of inflation, but the situation is becoming worse. But what went wrong? Hello everyone, welcome to Economy Expert. This is a one-stop destination to simplify your most complex queries about economics. Let's dive into today's video and see why everyone is thinking that a monstrous recession is coming. The Federal Reserve is preparing to raise interest rates significantly to confront the biggest inflation in more than 40 years, and an increasing number of forecasts now feel a recession is imminent. It's clear that growth in 2022 is expected to be hampered by the Ukraine conflict, Russian sanctions, China's zero-COVID policy, soaring inflation and interest rate increases by the US Federal Reserve. The concern is whether deteriorating circumstances and poorly thought-out policy decisions might cause the global economy to enter a downturn. If you're a regular visitor to our channel, you already know what a recession is. But still, let's have a quick look. A recession is when an economy has a reduction in economic production as well as income and employment losses. Although it's common knowledge that a recession starts when the GDP growth rate is negative for 2 consecutive quarters or longer, a recession can actually start before quarterly GDP statistics are released. There's no way to accurately forecast a recession. However, keeping an eye on crucial signs can offer perceptions into the state and trajectory of the economy, which in turn speaks to the risk of a recession. Such knowledge may and is used in decision-making at all scales, from the individual to the corporate level. At a time when the economy is robust by many metrics, it is an uncommon event. In the past year, employers have added roughly 6.5 million jobs, and the employment rate has dropped to only 3.6%. However, experts are worried about the economy and, in particular, the hot labor market, as firms scramble to hire more staff to keep up with the soaring consumer demand. Employers are bidding up salaries as they struggle to find qualified candidates, which is contributing to inflation rising beyond the Fed's target rate of 2%. The Federal Reserve in the US has the difficult challenge of reducing inflation without abruptly hiking rates and starting a recession. They're calling it the soft landing, but the central bank has historically failed to execute such soft landings. According to the majority of economists, it has only succeeded in doing so once, in 1994, when the then-chair Alan Greenspan managed a doubling of the benchmark rate without slowing down the economy. Experts are making it very clear that a worldwide slowdown would be felt, posing a danger to driving growth into reverse just 2 years after the pandemic caused the world economy to contract by 4.3%. Last year, the world's largest economy had its strongest increase in decades. But the United States' economic growth is already decreasing. The first quarter of this year's gross domestic product drastically contracted, marking the lowest result since the spring of 2020, when the economy was still struggling in the COVID-induced recession. According to the government's initial analysis of the statistics, GDP shrank by 1.4% on an annualized basis in the 3 months from January through March. That was much below the 1.1% increase forecast by Refinitiv experts, indicating that trouble may be on the way. On March 29th, the yield curve reversed for the first time since 2019. This occurs when interest rates on short-term treasury notes are higher than those on long-term treasury bills, an indication that investors are losing faith in the economy. Meanwhile, when a 50-point hike in interest rates was announced in May, Federal Reserve Chairman Jerome Powell dropped the other shoe on rumors of larger dosages of rate increases. In an effort to control inflation, he also sought to act a bit more swiftly by reducing the Fed's asset holdings. It was expected that the carefully watched April Consumer Price Index would demonstrate that the sky-high inflation had peaked and that prices were beginning to decline. In fact, prices increased more than anticipated in April, indicating that inflation will likely be high for some time. Inflation rate did indeed fall for the first time in the month, according to the Labor Department, but the measure still rose at an alarmingly rapid rate of 8.3%, approaching a 40-year high. On top of that, consumer sentiments became another reason to worry. According to a widely read study, consumer sentiment in the US hit a new record low in June, marking the lowest level ever noted. Since May, the index has fallen 14.4% as consumers' concerns about inflation have grown. The percentage of consumers who predicted poor business conditions in the future year rose to 79%, the highest level for that statistic since 2009. According to the June measure, 47% of consumers blamed inflation for lowering their standards of living, which is just 1% less than the all-time high set during the Great Recession. And this is really a matter of concern. Moreover, the benchmark S&P 500 lost more than 20% of its value this year and entered a bear market for the first time since the beginning of the COVID-19 pandemic. While the Dow Jones Industrial Average has also declined for 9 weeks in a row, the Nasdaq Composite is already into its own bear market. According to Susan Wachter, professor of real estate and finance, and Nikolai Rozanov, professor of finance, the Fed has the resources to avert a recession. Wachter said, the main cause that would trigger a recession now is a spike in interest rates. The Fed's actions so far and expected over through the end of the year will not in themselves trigger a recession. If prices do not decelerate as anticipated, the Fed faces a difficult path to a soft landing which does not destabilize the economy. However, now estimates from Goldman Sachs economists place the likelihood of a US recession in the coming year at 20 to 35%. Tim Harcourt, chief economist at the Institute for Public Policy, said, Biden's infrastructure stimulus will kick in. It may not save the Democrats in the midterms, but it might save the economy. China's economy will be hit by the new Shanghai shutdown. The Russia-Ukraine war also contributed to bringing the recession closer. Likelihood of further punitive measures in the upcoming months remains a risk factor, even though economies have so far fared quite well despite the conflict in Ukraine and the sanctions against Russia. There are rising calls to expand the sanctions and include gas and oil, which make up 40% and 1/3 respectively of the continent's supply, despite Europe's resistance to penalties on Russian energy, which has so far mainly focused on coal. Surprisingly, the job market is still booming, and according to Moody's Analytics, it won't be long until it reaches its lowest point since the early 1950s. The disparity between inflation and unemployment during the last 60 years and the Fed's stated targets for those indicators were tracked by Deutsche Bank. The Fed is far further behind the curve, according to that research, than it has been since the early 1980s, when exceptionally high inflation compelled the central bank to boost interest rates to all-time highs, crippling the economy. Going deeper into the Q2 survey results, it becomes clear that geopolitics, food and energy prices, and inflation are all related. When looking at how the C-suite ranks the external factors that are affecting their current outlook, over 40% of chief financial officers rank inflation as the top external risk to their business. As the Biden government struggles to increase oil supply and the war in Ukraine worries about a severe global food insecurity crisis, nearly 1/4 of CFOs cite Federal Reserve policy as the biggest risk factor. In addition, additional CFOs cited supply chain disruptions and the Russia-Ukraine war specifically as their top business risks. Burden of high costs at stores and petrol stations around the country remains on American consumers. People are also rapidly losing faith in the health of the economy. Even Fed officials are starting to lose some confidence in the future of the economy. Leading economist Bruce Kasman's team at JP Morgan Chase & Co. has increased the likelihood of a recession occurring within the next 12 months to an uncomfortably high 35%. They conclude that the risks are clearly titled to the upside on inflation and to the downside on GDP. Kasman says that lower-income households would be worst harmed in the coming days. Obviously, it does affect low-income people the most when you have a combination of high inflation and loosening labor markets, which isn't the situation right now, but would be in a recession. And that is the issue we'll be dealing with in this situation. A recession is undoubtedly widespread. It affects a wide range of economic sectors. Along with the United States, the entire global market is going to face the wrath of the upcoming recession. However, there are some tools and strategies to fight the recession. There are some ways you can minimize your financial damages. We'll inform you about that in our other videos. But first, it's important to know your perception. What do you think? How are you planning to face the recession? Don't forget to leave a comment about your opinion on this issue. And if you enjoyed watching this video, then please like, share and subscribe to our channel for more such exciting content.